In the vast universe of finance, few names shine as brightly as Warren Buffett's. Imagine, for a moment, having access to a mind that has turned investing into a true art. What makes his strategies so effective? What secrets lie behind his astounding success? The answer might be closer than you think. Before we begin, write in the comments, "I am ready for my financial transformation." Buffett isn't just an investor. He's a master at identifying opportunities. When most people panic, he sees potential. He teaches us that true wealth doesn't come from luck, but from informed decisions and discipline. Have you ever stopped to think about how patience and knowledge can be your greatest allies? In this universe, every mistake can be a valuable lesson, and every success is a step closer to financial freedom. The key is knowing when to act and when to wait. What would you do if you could adopt the mindset of one of the world's greatest investors? Get ready to embark on a journey that could change the way you think about money and investments. The power to transform your financial life is in your hands. Value investing is a philosophy that Warren Buffett has popularized throughout his career. Essentially, this approach seeks to identify stocks that are being traded at a price below their intrinsic value. This means that instead of being swayed by market trends or speculation, the investor should focus on companies with solid fundamentals that, for some reason, are being underestimated by other investors. This practice requires careful and detailed analysis, with the goal of finding opportunities that can bring significant returns in the long term. Buffett believes that by investing in undervalued stocks, it's possible not only to maximize gains, but also to minimize the risks associated with investing. He argues that the market often overreacts to news and events, leading to price fluctuations that don't reflect a company's true financial health. Therefore, by adopting a value investing approach, the investor can take advantage of these moments of uncertainty to acquire stocks at favorable prices. One of the keys to success in value investing is patience. Buffett has always emphasized that this type of investing is not a get-rich-quick strategy, but rather a journey that requires time and dedication. Investors must be prepared to hold onto their stocks for long periods, allowing the market to recognize the company's value and, consequently, raise its stock price. Thus, a long-term perspective is essential. Another important aspect of value investing is fundamental analysis. Memoria actualizada. Buffett and his team conduct a thorough evaluation of the companies they wish to invest in, analyzing factors such as profits, cash flow, debt, and competitive position. This rigorous analysis allows investors to identify not only the best opportunities but also the risks associated with each investment. Through this process, it is possible to build a robust portfolio that aligns with the principles of value investing. In short, value investing is an approach that combines detailed analysis, patience, and a long-term perspective. By focusing on undervalued stocks, investors can not only seek significant financial returns but also develop a deeper understanding of how the market and the companies they invest in operate. Focus on businesses with competitive advantages. One of Warren Buffett's most valuable teachings is the importance of investing in companies that have competitive advantages. These advantages can manifest in various ways, such as a strong brand, superior technology, economies of scale, or a unique business model. Identifying businesses with these characteristics is crucial because they provide a strong market position and the ability to generate consistent profits over time. Buffett often refers to these competitive advantages as an economic moat. This concept describes a company's ability to protect its profits from competitors by creating barriers that make it difficult for new players to enter the market. For example, globally recognized brands like Coca-Cola or Apple have a significant economic moat due to consumer loyalty and constant innovation. Investing in companies with a well-defined economic moat is a smart strategy, as these companies tend to perform better during times of crisis. Moreover, Buffett believes that companies with competitive advantages are more resilient to economic fluctuations. When the market goes through turbulent periods, these companies are usually able to maintain their profits and, in some cases, even thrive. This is due to their solid position and ability to adapt to changes in consumer demands. Therefore, when choosing investments, it is crucial to carefully analyze the competitive advantages of companies. Another important point is that these advantages are not permanent. The market is dynamic, and conditions can change rapidly. Thus, the investor must always be attentive to innovations and changes in consumer behavior. A company that today has a clear competitive advantage may, in the future, find itself threatened by new technologies or disruptive business models. Therefore, constant vigilance is essential to ensure that investments remain sound. In summary, focusing on businesses with competitive advantages is a fundamental strategy in Buffett's investment approach. By identifying companies with an economic moat, an investor can ensure they are making choices that not only offer potential returns, but also provide protection against market uncertainties. Discipline and patience are fundamental pillars in Warren Buffett's investment philosophy. In a world where market volatility can be overwhelming, many investors let their emotions guide them, leading to impulsive decisions that can result in significant losses. Buffett, however, emphasizes the importance of staying calm and sticking to a well-defined investment strategy, regardless of short-term market fluctuations. One of Buffett's key teachings is that investing is not a sprint, but a marathon. The mindset of quick gains may be tempting, but it usually leads to hasty and incorrect decisions. Buffett recommends that investors adopt a long-term perspective, focusing on the growth and appreciation of the companies they invest in, rather than worrying about daily market movements. This approach requires a significant level of self-control and the ability to resist the pressure of the moment. To cultivate discipline, Buffett suggests that investors develop a clear plan and follow it rigorously. This includes setting investment goals, identifying companies that align with those goals, and resisting the temptation to sell stocks during moments of panic. Discipline also involves the willingness to conduct thorough analysis before making any investment, ensuring that decisions are based on solid data rather than assumptions or rumors. Patience, in turn, is equally vital. Buffett believes that great returns come from the time spent investing in solid companies. Often, the true value of an investment only becomes apparent years after its acquisition. Therefore, investors must be willing to wait and allow their stocks to grow and appreciate. This patience is often rewarded when the market eventually recognizes the true value of the companies. In summary, discipline and patience are essential for success in investing. By adopting a calm and methodical approach, investors can avoid emotional pitfalls and make informed choices that, in the long run, will lead to positive returns. Buffett's philosophy teaches us that true success in the financial market is the result of a focused mindset and a well-executed strategy. Reinvesting profits, one of the most effective strategies Warren Buffett uses to maximize wealth growth, is reinvesting profits. Instead of withdrawing the profits generated by his investments, Buffett chooses to reinvest them in the same company or in new investment opportunities. This practice allows capital to grow exponentially over time by leveraging the power of compound interest. Over time, this strategy can lead to a significant increase in the total value of the investment. Imagine you have an investment that generates a 10% return per year. By reinvesting these profits, you are not only increasing your initial capital but also generating returns on the returns. This snowball effect is crucial for long-term growth. Buffett understands that by reinvesting, he is not just increasing his wealth but also creating a solid foundation for future gains. Additionally, this reinvestment strategy is particularly valuable during periods of low market volatility. When markets are calm, reinvesting profits can be a powerful way to build wealth, as the investor has the opportunity to buy more shares at favorable prices. Over time, these shares can appreciate, leading to even greater returns on the invested capital. Another advantage of reinvesting profits is the ability to seize market opportunities. Often, after generating profits, new investment opportunities arise. Buffett uses his reinvested profits to acquire shares in companies he considers undervalued or with growth potential. In this way, he not only increases his stake in companies he already owns but also diversifies his assets. Finally, it's important to highlight that reinvesting profits is not just a financial strategy but also a long-term philosophy. Buffett believes that by focusing on sustainable growth and continually reinvesting, investors can achieve extraordinary results over time, avoiding the temptation of immediate gratification that often leads to harmful financial decisions. Financial education and critical analysis. Financial education is one of the keys to successful investing, and Buffett emphasizes the importance of understanding financial principles before making any investments. For him, it's not enough to just have a certain amount of money. It's crucial to know how that money can work for you. Financial knowledge allows investors to make informed decisions instead of being swayed by market speculation or euphoria. Critical analysis is equally essential. Before investing, Buffett recommends conducting a thorough analysis of the companies you intend to invest in. This involves studying the business fundamentals, such as its market position, management quality, and financial health. This approach helps the investor identify companies that not only have growth potential but are also resilient in times of crisis. A common mistake among novice investors is the tendency to follow the crowd. People often get caught up in rumors or short-term trends, leading to impulsive decisions. Buffett, on the other hand, advises investors to stay true to their analysis and not be swayed by temporary market fluctuations. This kind of discipline is crucial to avoid significant losses and ensure sustainable growth. Beyond understanding numbers and charts, financial education also involves a broader comprehension of the economic environment and market trends. Knowing the forces that drive the market can help investors anticipate movements and position themselves more strategically. Therefore, investing time in learning about economics and finance can be one of the best investments someone can make. Ultimately, financial education and critical analysis are the responsibilities of the investor. One should not blindly rely on tips from others or short-term recommendations. Instead, each investor should commit to understanding the principles that govern their money, thus ensuring a more secure and promising financial future. This grounded approach is what distinguishes successful investors from those who often face financial difficulties. Building a diversified portfolio. Warren Buffett, one of the most respected investors in the world, has always emphasized the importance of diversification in building a portfolio. Contrary to the popular belief that diversification simply means having a large number of investments, Buffett argues that the focus should be on choosing assets that we truly understand. The idea is not to put all your eggs in one basket, but also not to buy shares of just any company to increase the number of assets. The real value of diversification lies in selecting companies that, together, form a balanced and cohesive portfolio. When constructing a diversified portfolio, it's essential to consider different sectors of the economy. This means that instead of investing only in technology or consumer goods, an investor should look at areas like healthcare, energy, and finance. This approach helps minimize risks because if one sector faces difficulties, the others can offset those losses. Buffett believes that smart diversification allows investors to benefit from different economic cycles, providing additional protection against market volatility. Another crucial aspect of diversification is analyzing the correlation between assets. Investing in stocks of companies that move in opposite directions under different economic scenarios can be an effective strategy. For example, while technology stocks may appreciate during times of economic growth, stocks in defensive sectors like utilities may remain stable during recessions. When building a portfolio, it's wise to include assets that may react differently to market events, increasing the security of the investment. Buffett also advises investors to focus on assets they know well. Diversification should not only be about quantity but also quality. Selecting companies with strong fundamentals and competent management is crucial. Therefore, before adding a new stock to the portfolio, it's important to understand how the company operates, its challenges, and its growth potential. This deep understanding can make all the difference over time, leading to more informed investment decisions. Finally, diversification should be viewed as an ongoing process. The market is constantly changing, and what might be a good diversification strategy at one time may not hold up in another. This means that investors need to be willing to regularly review and adjust their portfolios. Buffett often suggests that over time, we should ask ourselves if our investment choices still make sense. This constant review helps ensure that the portfolio remains aligned with the investor's financial goals and current market conditions. The importance of a long-term perspective. One of the core principles of Warren Buffett's investment philosophy is the importance of having a long-term perspective. In a financial world often driven by the pursuit of immediate profits and risky speculation, Buffett reminds us that true wealth is built over time. Investing with a long-term horizon allows investors to ride out market volatility and benefit from the continuous growth of the companies they invest in. This long-term approach is also closely tied to the concept of compounding, or compound interest. By reinvesting profits, investors can see their capital grow exponentially. Buffett argues that rather than seeking quick sales and profit withdrawals, it is more advantageous to leave the money invested and let it grow. This compounding effect can turn a modest investment into a significant sum over decades, highlighting the importance of patience and discipline in investing. Moreover, having a long-term view helps investors avoid impulsive decisions based on short-term fluctuations. The market can be volatile, and it's easy to get caught up in panic or euphoria. Buffett always advises keeping calm and trusting in the fundamental analysis of companies. By focusing on long-term performance, investors can ignore temporary distractions and concentrate on the fundamentals that truly matter for the success of an investment. Another important aspect of a long-term perspective is the ability to endure market downturns. All investors face challenging times, and it's natural for stock values to fluctuate. However, those who maintain a long-term perspective are more likely to resist the temptation to sell during downturns. Buffett often mentions that instead of worrying about declines, investors should view them as opportunities to buy more shares of companies they believe in at lower prices. In the end, a long-term vision applies not only to investing in stocks but also to building a diversified portfolio. Understanding that wealth and financial success take time to materialize is crucial for any investor. By adopting this mindset, investors can make more informed decisions, resist market pressure, and ultimately achieve their financial goals more effectively. Now that you know the strategies that made Warren Buffett one of the wealthiest men in the world, it's time to reflect on how to apply these teachings in your own life. Take a moment to think. Are you truly ready to change your relationship with money? Are you prepared to adopt a long-term investor's mindset, even if it requires patience? Buffett always said that time is your best ally. So, the question is, what are you doing today to secure your financial future? Have you considered what asset you could start investing in right now? Moreover, how can you turn small daily habits into great opportunities for wealth? Remember, the path to wealth isn't just about money, but also about knowledge and discipline. Every decision counts, and every step you take can bring you closer to your goal. What lessons have you learned today that you can apply immediately? Continue this journey, seek more knowledge, and above all, believe in your potential. You have the power to transform your reality. So, are you ready to take the next step?